I think a lot of financial due diligence in these businesses is sifting through a ton of add backs, personal expenses that sellers are running through the business, and just making sure that those are all verifiable. Never add back cash jobs to the profits of a company. I know a lot of brokers and sellers try to do that. That's something that we can't do and a lot of other banks can't do. If there's government subsidy funding, always make a negative adjustment for that. So if they received a PPP loan, don't include that in the revenue and profits, or an EIDL loan or employee retention tax credit. Always back those out. If they've sold 7 trucks in a year and they're showing that as other income, that's probably not going to be reoccurring income. So make an adjustment for that. And really, customer concentration work mix, I can't harp on that enough, is really important for us. And then also, if you see that revenue is, we see a ton of businesses where revenue has been flat 2020, 2021, 2022. They decide they want to sell in 2022. So they start reporting everything correctly in 2023. And you see a huge spike in revenue and earnings and ask tons of questions. Hey, like, what happened here? Is this sustainable? I already know my bank is going to ask me tons of questions. It's really like looking at trends with revenue and margins, KPIs. I think is pretty important in due diligence. And also, don't overlook payables and receivable reports. If a business is struggling with accounts receivable, that's going to be tough to manage cash flow cycles. And then if they're not paying their suppliers, then you could be buying a business that doesn't have a good relationship with those suppliers, which kind of you come in at an awkward stage as a new owner. So I think all those are really important to spend time on.